video, we'll talk about what you can expect from this course. What we'll cover in this course are all the principles that we apply which lead us to find success in the financial markets. We'll teach you how we identify the direction of price, whether we believe price will move to the upside for a particular instrument or whether it will move to the downside for a particular instrument. We'll teach you how we identify clean entries, meaning we are a trading school that prides ourselves in identifying clean entries, being entries with minimal to no drawdown. We do not want to be sitting in prolonged negatives before price moves in our favor. And so therefore, we are about precision and we are about identifying precise entry points for our trades. We'll also talk about how we identify clear targets for our trades, just as important as it is to identify direction, to identify clean entry points. It is also very important to identify clear targets for our trades. You don't want to get involved in a trade, engage with either a buy or a sell position, and not know at which point you are going to be taking your money off the table. So we'll teach you the principles that we look for in order to identify clear targets for our trades. And then lastly, also how we identify predefined risk. It is very important to engage with a trade, understanding exactly how much you have at risk on that particular opportunity. You never want to engage with a trade simply focusing on the potential return, failing to look at how much of your account is actually being exposed. Also, should you decide to continue with our mentorship program or enroll into our mentorship program, which is absolutely free, provided that you open a trading account with our preferred broker or the broker with which we are partnered with, and funding your personal trading account with the minimum amount, you'll get free access to our mentorship program. It is not compulsory that you take part in the mentorship program, but it is a pivotal part of any trader's trading journey to have access to a mentorship program. It's kind of senseless learning principles, but then not getting mentored based on those principles. So we highly encourage you to enroll in the mentorship program after you have completed this course. In the mentorship program, we reiterate the principles that we teach in the course, but we do so in live markets. And we do this with pre-market chart analysis, teaching you how to implement the principles that are taught in this course, but in a live market. And we also then follow those chart analyses up with live market updates. These live market updates help the trader to learn how to think in a live market and how to implement the principles we will teach in this course in live markets. Oftentimes traders do a course and then they get to live markets and they freak out. Where over here with this, the intention is to assist and to aid and to mentor the trader in an actual live market. What we also do is we do weekly mentorship calls. These mentorship calls are pre-recorded and uploaded in a channel for our traders to watch at their own convenience, to rewind, to pause, to make notes, to rewatch, etc. They will have continuous access to these videos should you wish to use them as a means to study. In this video, we'll cover a couple of frequently asked questions. The number one top question that is asked to us is it easy? The simple answer is no. It is said that trading is the hardest way to make easy money. So does it become easier over time? Yes, absolutely it does become easier over time if you choose to follow the rules that we teach and follow the principles that we teach. But is it easy to begin with? Absolutely not. Will it take time? Yes, it will. So trading, just like any other craft or just like any other skill, is learned over time. Whether you are a nail technician, whether you are a welder, whether you are a mechanic, it has taken you a certain period of time to get to where you are at the moment in your profession. The same is true with trading. It is often marketed as though it is something easy. And as soon as you do a particular course or meet up with a particular trader, it is going to become easy and you'll become profitable overnight. This is unfortunately not true. You want to treat this as though it is a skill that you are learning over time and not treat it as though it is a casino. Will I have losses? Yes, absolutely you will. Losses are a part of the game, and we accept these losses. We do not mind them. But what we do mind are unnecessary losses, and therefore we have a systematic approach. So throughout your trading journey, you will take losses. We take losses too. Any trader that tells you that they do not take any losses is lying through their teeth. Losses are part of the game. We accept the losses, and we do not mind them. But what we do mind are the unnecessary losses. So follow the systematic approach that will teach you, and you'll be okay. How much money can I make? We always encourage traders to never focus on the money, but to rather focus on the skill. The money is a result of the skill. If we do not have the skill down and we focus too much on the money, we may end up losing more money than we had bargained for. Okay, the skill will in turn pay you. Don't get caught up in the hype of social media and all these types of things. Follow the process. Okay, the amount of money that you'll eventually make will be in direct proportion to how you have focused on the skill. Will I have support? Now, if you decide to join our mentorship program hereafter, absolutely. Our mentorship program is set up in a manner that we wished we had when we first started trading. Okay, and we do find that those that take full hold on what is on offer in the mentorship program often tend to do the best. We do understand that certain traders will do our course that are already skilled and might not need the mentorship benefits, okay, and simply just want the course content to refine their entries, to refine their targets, to refine their risk parameters, etc. However, we do highly encourage joining the mentorship program. As I've said, access to it is completely free. We do not charge for access to the mentorship program. It is in partnership with our broker XM. And so therefore, all you need to do is simply request the link, open up your trading account via the link that we share with you, and fund your trading account with the minimum amount. And thereafter, you get free access to the mentorship program. So will you have support? Absolutely. In this particular video, we will be covering the trading applications that we make use of. Now, the first trading application we make use of is TradingView. Now, TradingView is a charting platform, and it is, in fact, a website. So you can go to tradingview.com and open a free account. You do not need the paid version. I do have the paid version, but it's not completely necessary. So open up a free TradingView account, and this account can be logged into via the website on your laptop or your PC. But you can also download the TradingView application on your mobile device. This will allow you to log into the same account. And if you had done any analysis using your laptop or your PC, you will then be able to log in via your cell phone or your tablet, and you will be able to see the exact same analysis on that particular device. Now, TradingView is a charting platform that provides data from various providers. You will see various brokers over there providing their charts. And the only data that we use, the only charts we use are the charts provided by Oanda. Now, Oanda is a Forex trading broker, but you do not need a trading account with Oanda. All we do is we use the data provided by Oanda in order to analyze. So we will never use charts provided by any other provider other than Oanda. The reason for this is that we believe that a WANDA provides the most accurate representation of price. And so therefore we make use of a WANDA's charts on TradingView in order to analyze. MetaTrader is an application that is used to execute trades. So MetaTrader is a trading platform. You will then log in to your trading account that you had opened with your broker via MetaTrader, and the funds deposited into your Forex trading account with your broker will then be used in order to execute these trades. MetaTrader 4 is a very popular choice of traders in order to execute trades, but we do not make use of MetaTrader 4. We make use of MetaTrader 5 because of the additional features that it provides us with. So MetaTrader 5 is used for execution of trades. We use investing.com. Investing.com is a website, but they also have an app that can be downloaded onto your mobile device. You do not need to open an account with investing.com. You can simply just use it in order to identify the news releases that are occurring for the day. Now, with news releases, we will have 1 bull, 2 bull, or 3 bull news releases. These this is just a grading system for these news releases. 1 bull would be your low impact news releases, 2 bulls would be your medium impact news releases, and 3 bulls would be your high impact news releases. We are only concerned about the high impact news releases. So we'll filter out the 1 bull and 2 bull news releases only to show the 3 bull news releases. You want to know when these are occurring because, number one, if you are a conservative trader that wants to stay out of the market at that time, because of the increased volatility that we'll have in the market around the time of a news release, you will then be adequately prepared and you will know when to be out of trades, when to not engage, etc. If you are a more aggressive trader that wants to trade around the time of these news releases and capitalize off the volatility in the market at that time, you also want to be aware of the time that these news releases are occurring. So investing.com is used to identify when there are high impact news releases that will be occurring in the market. Now we do have tutorials in our library on Telegram in order to guide you in setting up these particular applications. Now, there are various instruments that can be traded. The price of each of these instruments are depicted by these candlesticks. Now, these candlesticks depict the fluctuation of price over time. We have up-close candlesticks, and we also have down-close candlesticks. Now, the up-close candlesticks, as you can see from these charts, are the white ones. They are referred to as bullish candlesticks, which we'll cover a little bit later on. We also have down-close candlesticks, which are your blue candlesticks, and they are referred to as bearish candlesticks. Now, when we're referring to up-close or down-close, it just means that in that particular period of time that candlestick had formed, price moved to the upside overall. When we're looking at the blue ones or the down-close candlesticks, what that means is that during the period that those candlesticks had formed, price moved to the downside overall. Now, with up-close candlesticks or your bullish candlesticks, price would open at a certain region and it would close at a certain region. Candlesticks also have a low and a high. So during the period in which this candlestick had been formed, price would have opened at this region. It would have pushed down to this region, which we identify as a low, forming that lower wick. Price would push to the upside, creating the high, and it would form that wick as price pulls down and closes at this region over here. Now, these candlesticks form over a certain period of time, and we have various time frames that we can analyze these charts on. For example, a candlestick on a 1 hour time frame will take 1 complete hour to form, whereas a candlestick on a 15-minute time frame will take 15 minutes to form. It will take 4 15-minute candlesticks to form 1 hour candlestick, or rather, over the period that it takes to form 4 consecutive 15-minute candlesticks, one hour candlestick would have formed as well. So it's just depicting price over a different period of time. With your bearish candlesticks or your down close candlesticks, the same thing occurs. Over here, price had opened at this particular region, but conversely to your bullish candlesticks or your up close candlesticks, over here, price had opened over here, pushed to the upside, creating the upper wick, pushing to the downside, creating the lower wick, and then closing at this region over here. The same thing occurs over here, where you have various time frames depicting the movement of price over a certain period of time. So in this instance, in a bearish candlestick, you will have an open over here, which forms the body of the candlestick, the open to the close, that forms your body of your candlestick. And as price had pushed up, it would have formed your high, which is the wick to the upside. And as it pushed down, it would have formed the low, which is your wick to the downside. So in this lesson, we'll be covering market structure. Now, the manner in which these candlesticks form in succession creates what we refer to as market structure. And market structure refers to the flow of price over time. Now, these candlesticks, they are created as price flows, and we will see the following trends being created as price flows. In this instance over here, the highlighted area over here will be referred to as a downtrend because price is trending to the downside. Now, we refer to this as a bearish trend. The idea behind that is that when you think of the animal, a bear, bears strike or attack by striking their paws to the downside. So over here, we have a bearish trend or a downtrend. In a downtrend, your sell positions will be your most highly probable opportunities. And when referring to market structure, price creates structural points in the market. It will create highs or lows, as price trends to the downside. So that is your bearish trend. And when referring to structure, we are referring to the structural points that price creates as it trends. You'll also have an uptrend. Now, in an uptrend, you will see price trending towards the upside. An uptrend is also referred to as a bullish trend. And if you think of the animal, a bull, bulls attack by bringing their horns upward. Therefore, the term bullish, creates structural points in the market, structural lows and structural highs. But overall, price is trending to the upside in this particular trend, and your most highly probable trades over here, or your most highly probable trading opportunities will be buy positions. We'll also have instances where we'll have price ranging. It will create a range. In this instance over here, price is stuck between a floor and a ceiling. There is no clear trend over there. Price is essentially just moving sideways, bouncing between a floor and a ceiling. Now, when price is in a range, there is no clear direction, no clear trend. And so therefore, in this instance, you would just simply relax, and you'll wait for the market to show you its hand. There are certain principles that we look out for here in order to execute, but that we will look at a later stage in this course. Also, what is important to understand is that when price trends, it will move in two phases. You'll have the following two phases: an impulse phase and also a correction phase. Now, let's have a look at this chart over here. We can see that over this period of time, price was trending to the upside. As you know, when price unfolds, it creates structural points. Over here, the last structural point that price has created was this particular low. Thereafter, we see that that low has been broken. Price has now aggressively moved to the downside with momentum, and it has broken this low. When you look at these candlesticks, you can see that they are fairly large. Okay, indicating momentum. Price has aggressively, with momentum, moved to the downside, and it has broken a previous structural low that has been created. The momentum to the downside that breaks this low is referred to as an impulse. This is your impulse phase. Now, this particular low that has been broken by this momentum, we refer to this as a break of structure, because a structural point that price has created has now been broken by this momentum. This indicates to us that we can potentially look for a sell. You always want to remember, when selling, you want to sell high. So you do not want to engage in sell positions right over here, simply based on the momentum. The momentum that has broken that structure indicates to you that sellers are now in control of the market. So you want to look for a valid opportunity to sell. So it is simply an indication, but it does not give you a reason to pull the trigger with sell positions as yet. We will look for price to first do a correction. Okay, so this is your correction over here. This is price pulling back. Now, when you look at the correction, you'll be able to see that price does so with way less aggression than the impulse. How we identify this, we can see that the candlesticks are less aggressive. There is less momentum over here. So your correction will be the move that follows, or the phase that follows your impulse. We will then identify a region from which we can engage as sellers. And how we identify this is by looking for the indecisive candlestick prior to the momentum that has broken the structure. Remember, this was the momentum here that has broken this particular low. We will look for the indecisive candlestick prior to that momentum. Now, indecision simply relates to a candlestick that is fairly small, possibly with a small body, and sometimes a little wick to the upside, and sometimes even one to the downside. This little white indecisive candlestick over here, in this instance, does not have the lower wick, but that does not really matter. We can see by the nature of this candlestick that price has been indecisive in that region. It has not aggressively moved to the upside, nor aggressively moved to the downside. It was simply just price hovering in that region. Over here, this is momentum. We can see that price is aggressively moving to the downside based on the size of these candlesticks. So we box out our supply zone. Okay, this is referred to as a supply zone. We box it out from the high of the candlestick to the low. So that little shaded, gray shaded area over there, that is our supply zone. And that is a zone from which you would be interested in selling when price returns there. Over here, we see that price falls from that supply zone, and our entries would be right in over here. Now let's have a look at this particular one. Over here, we can see that price was trending to the downside. Not an aggressive trend, it's been doing so very slowly, but nonetheless, we can see that price has been moving to the downside. This was the last high that price had created as it trended to the downside. This is our structural high in this particular example. Following that, we see that price has broken that high with this momentum. It has done so in an aggressive manner. We can see this by the size of the candlestick. Now, what is very important to note is that momentum can sometimes occur with a single candlestick, like in this example, or by a series of candlesticks, as per the previous example. So this over here is your impulse in this particular example. That is an aggressive candlestick breaking a previous structural point, in this case, a structural high. Now, this is referred to as a break of structure once again. This impulse breaking the previous high, okay, you've got an impulse, you've got momentum to the upside. This indicates to us that buyers are in control of this particular market. And so therefore we want to engage as a buyer. So this is merely an indication to you that buyers are in control, but it does not give you any reason to pull the trigger and place buy orders over here. We'll never engage simply based on momentum. Momentum to the upside that breaks structure indicates that buyers are in control. We'll always wait for price to do a correction. Over here, we see price doing the correction after that impulse. When we look at this, we see price pulling back with way less momentum, way less aggression than it did with that impulse. Okay? It takes quite a few candlesticks to sort of correct what the impulse has done. In this case, we will identify a region from which we can buy. And over here, we'll box out, once again, the indecisive candlestick, the little blue one in this case, prior to the momentum that has broken structure. That little blue candlestick, we box it out from the high to the low, indicated by this gray shaded box over here. That is where we are interested in buying. Okay, so we'll wait for price to do the correction, and when once price returns to our demand zone, that is where we would be interested in buying. Here we see price rocketing from that particular demand zone. Also, just to note, the color of the candlesticks do not matter. Over here, the color is blue, yes, but even if that was a white candlestick, we'll still use it. We are simply looking at the nature of that candlestick, the characteristics of that candlestick. We want to see indecision. We want to see a region where price was indecisive, where we had a little candlestick that did not have clear momentum to the upside, nor clear momentum to the downside. It is essentially just price hovering in that region, and thereafter we had the momentum. So the color does not matter. Simply what we are looking for is momentum that has broken structure, and then identifying the indecisive candlestick prior to that momentum. When price returns there, that is where we will be engaging as a buy with a buy order. Over here, when price is in a range, there is no clear impulse nor any clear correction because price is not trending in any direction. And so over here, like we said, price is stuck between a floor and a ceiling. So we're not going to be looking for any impulses or corrections over there because price is simply moving sideways. In this video, we'll cover 3 steps to correctly identify valid supply and demand zones. Now, in order to validate these zones, we need to follow the following 3 steps, identifying these characteristics. The first one is identify momentum. In this example, that is your momentum over there. The second step is to identify your break of structure. This was the structural high over here that momentum had broken. Let me just annotate that on the chart for you guys. That was the high that was broken by this momentum over here. So Momentum that breaks structure is what we know as an impulse. Then your third step is to identify the indecisive candlestick, regardless of the color, prior to the momentum. When price returns to that region, that is where you will be interested in engaging with the trading opportunity. Got two examples for you guys. Step number one, over here we identify momentum to the downside. This is identified in a single candlestick because momentum can be identified in consecutive candlesticks or sometimes in a single candlestick as per this example over here. We've got momentum to the downside, step number one. Step number two is identifying a break of structure. Over here, we've got this structural point over here. Price has created a low, and with this momentum, it has broken that particular low. That is your break of structure. So this validates this as an impulse. So number one, identify momentum. Number two, identify a break of structure. This now indicates to you that sellers are in control and you want to engage as a seller. You do not want to sell low, you want to sell high. Therefore, we identify the indecisive candlestick prior to the momentum that has broken structure. In this case, it is the white candlestick over here. Indecision relates to a candlestick in which price is not aggressively moving to the upside nor aggressively moving to the downside. It is essentially just hovering in that region. We box our candlestick out from the low to the high, and this becomes our supply zone from which we are interested in selling when price returns there. With this example over here, we see price tapping the supply zone in which we are interested in entering as a seller, and we sell as price taps the supply zone. And over here, we see price continuing to the downside. In this example over here, we have momentum running to the upside over here in that particular portion of price over there. Now, number one, you want to spot momentum. Number two, you want to see whether that momentum has broken structure. So you're going to be looking to the left to identify a previous high that price has broken. So this is a structural point that has been created here. And with this momentum to the upside, we see that price has broken that structural high. That validates this as an impulse. Then you want to look for the indecisive candlestick, which is step number three. The indecisive candlestick prior to the momentum that has broken the structure. Now, I've purposefully chosen this example because over here we see the momentum has begun here, but over here, prior to it breaking the structure, we see that price has become indecisive. In an instance like this, we are not going to look all the way down at the bottom. We are simply going to look for the indecisive candlestick prior to the momentum that has broken the structure. And in this case, it is the little white candlestick over here. We see that we have three indecisive candlesticks, white, blue, white. It is the white one prior to the momentum that has broken the structure. Over here, we see price pulling back to that region, offering us an entry to execute a buy order to run price to the upside. So it is very important to take note as to where the break of structure has originated from. Over here, just to reiterate, this is your impulse, and oftentimes your zone you are interested in this case your demand zone, can be found midway through your impulse. In this video, we'll be talking about identifying valid targets for our trades. Just as it is important to identify the direction that price could take, and just as important as it is to identify valid entry points, it is also very important to identify valid targets for our trades. And the principles that we use in order to validate targets is imbalance and also liquidity. Now, it is very important to understand this, that price moves for two reasons. And if we understand why price moves, we can validate reasons as to where it could potentially move. So price moves either to fill imbalance or to hunt liquidity. And so therefore we will look for either imbalance or liquidity points as targets. So we'll focus on imbalances in this first section of the video. Now, imbalances are created when there is an uneven distribution between buying and selling activity. Now, price moves aggressively in these instances in favor of either buyers or sellers. So, for example, if we had a scale, and on this scale, we had buyers on the one side and we had sellers on the other side. Let's say we had buyers here and we had sellers here. And if we had an equal amount of buyers as opposed to the amount of sellers, then the scale would balance. However, if there were more buyers than there were sellers, the scale would tilt to the side of the buyers. And this would create what we refer to as buy-side imbalance. Now, imbalances are indicated by a series of no less than 3 consecutive candlesticks, and they are measured by the high of candlestick number 1 and the low of candlestick number 3. So in this example over here, we have 3 consecutive candlesticks with price moving to the upside. The first being the little blue indecisive candlestick, the second being this white candlestick filled with momentum, and the third being this candlestick over here that is also filled with momentum. They are 3 consecutive candlesticks. Now, if we look at the high of candlestick number 1 and the low of candlestick number 3, they do not meet up, leaving this gap between them, which we refer to as imbalance. Now, we also have sell-side imbalance, where if there are more sellers than buyers in the market, the scale would tilt to the seller side. And this would create what we refer to as sell-side imbalance. Now remember, imbalances are created by no less than 3 consecutive candlesticks, and we measure them from the low of candlestick number 1 to the high of candlestick number 3 if price is moving to the downside. Over here, that's the low of candlestick number 1, and that's the high of candlestick number 3. So in this particular example over here, that is the imbalance that we have in this particular example. Now, it is important to take note of these imbalances, guys, because price will be drawn to these regions and thereby filling these imbalances. I'm going to show you guys an example over here. Now, when we're looking at this chart over here, this is a chart, this is a German 40. It's actually German 40. I'm not certain as to why Oanda hasn't changed the name. Still have it listed as German 30, but it is in fact the German 40. Over here, we see that price has ran with momentum to the upside. Has it broken structure? Yes, it has. Remember your 3 steps. Number 1, identify momentum. Number 2, identify whether that momentum has broken structure. And then number 3, look for the indecisive candlestick prior to that momentum. In this case, it is the little blue candlestick over here prior to the momentum that has led to price breaking that structure. So we know that this is a region that we are interested in buying from. Over here, we see price returning to that region to offer us an opportunity to buy. Now, if we look at this region over here, if we just zoom in on it, we'll see that on the way down to this demand zone from which we were interested in buying, price has now in fact created imbalance over here, identified by 1, 2, 3 consecutive candlesticks, and we see that the low of candlestick number 1 and the high of candlestick number 3 do not meet up, leaving this region of imbalance. Over here, we see price running up, filling that imbalance, which will be your target for your trade. And thereafter, we see price pulling back from the region. So therefore, it's very important to identify these imbalances in the market so that you do not enter a trade, beautiful execution on the demand zone, and then seeing beautiful profits and then price literally pulling back against you. In this example over here, we see this is a US 100 chart, NAS 100. Over here, we see that we've actually had momentum to the downside over here. So you always want to take note, where is price reaching toward? So we've had this momentum over here, that momentum over there, and we ask ourselves whether that momentum, even if you just want to look at the massive blue candlestick, did that momentum break structure? We had this low over here that momentum has broken. If that is so, we can then look for the indecisive candlestick prior to that momentum that has led to the break of structure. And here we can see that price is in fact returning to that supply zone from which we would be interested in selling. So if you're selling from the supply zone, we need a target for our trade. And over here we can see that there's been imbalance beneath on the way to price returning to that supply zone. You look at these 3 consecutive candlesticks, number 1, number 2, and number 3, we can see that the high of candlestick number 1 and the low of candlestick number 3 do not meet up, leaving that region of imbalance. In this screenshot over here, we see price tapping into your supply zone to give you a sell entry, running down to fill that imbalance, which would be your target for your trade. Thereafter, we see price pulling back from that region and then completely reversing. So it's important once again to identify these regions and use them as valid targets for your trades so that you are not caught in price reversing on you in that manner. In this video, we'll talk about another principle that we use in order to identify targets. Now, remember, as we discussed in the previous video, that price moves for 2 reasons, either to fill imbalance or to hunt liquidity. So in this particular video, we'll be talking about liquidity points and how to identify them. It is very important, as I mentioned previously, that we understand that price moves for these two reasons, so that we will be able to identify valid regions as targets for our trades. Now, what are liquidity points? Points are essentially specific or fixed price levels on a chart where we can anticipate an influx of orders. Now, liquidity points are essentially identified by prominent highs or prominent lows on a chart at which the average trader is interested in engaging. So price is drawn to these levels and can oftentimes reverse from these levels. And so therefore, we want to use them as valid targets for our trades because you do not want to see price reversing on you when sitting in a beautiful position. So for example, over here, we see price running with momentum to the downside. This is a UK 100 chart. You'll see that we use various examples of different charts so that we can show that these principles work on pretty much any instrument. We've got momentum to the downside. Remember, that's step number 1. Step number 2 is identifying whether that momentum has broken structure. Over here, we see a structural low that momentum has broken. We can then look for the indecisive candlestick prior to that momentum, step number 3. And this becomes our supply zone from which we are interested in selling. Should price return there, we'd be engaged in a sell position there or interested in selling from that region. Over here, we see price returning to our supply zone, but on the way to that supply zone, price has now created a new prominent low, which we identify as a liquidity point, as a target for our trade. Here we see price tapping into our supply zone to offer us a sell opportunity. And over here we see price dumping towards our liquidity point. From there, we see price pulling back. And so therefore, we always want to identify these liquidity points on our chart so that we can use them as valid targets for our trades. Here's another example to the upside. Once again, step number one, we've got momentum to the upside. We ask ourselves the question, did that momentum break structure? Remember, price creates structural points as it flows. Now over here, we've had a high that price has created, but with this momentum, it has broken that high. So that's a valid impulse to the upside over there. Remember, step number one, identify momentum. Step number two, identify whether that momentum has broken structure, and then we can identify our indecisive candlestick prior to that momentum that has broken structure. In this case, the little blue indecisive candlestick is our demand zone from which we are interested in buying. Over here, we see the correction toward that demand zone to offer us a buy opportunity. And over here, we've got a prominent high that price has created. That high is known as a liquidity point. Over here, from our demand zone, we see that price runs up toward the liquidity point. Once price has reached that liquidity point, we see price completely reversing. So therefore, once again, it is always very important to identify these valid targets for our trades so that we are not caught in these types of reversals. Now, in this video, we'll talk about how we can catch reversals from liquidity points. Now, in the previous video, I've shown you how we can use them as targets. And I've also shown you how that oftentimes from those liquidity points, price reverses. Now, liquidity points, as you guys know, are specific price levels on the chart. And around these levels, we can anticipate an influx of orders from traders. Now, these liquidity points are identified by prominent highs once again and prominent lows. And around these regions, the average trader is interested in engaging. So price is drawn to these levels and can oftentimes reverse from these levels. So in this lesson, we're going to be focusing on how we can catch those reversals from liquidity points. And these reversals from these liquidity points are referred to as liquidity grabs. Now, in this particular example over here, we can see that price is stuck in a range, stuck between a floor and a ceiling. It's essentially moving sideways. It's neither trending to the upside nor trending to the downside. When price ranges like this, it generates liquidity above or around the high of the range and also around the low of the range. Now, just as we know liquidity points are identified by prominent highs and prominent lows, they can also be identified by the high of a range or the low of a range as well. Over here, we see price breaking out of that range. Now, in this instance, we would not be interested. We are not what you refer to as breakout traders. Breakout traders would see price breaking a level or breaking out of the range in this case, and they would hope that price would continue to the downside. Over here, we see that price breaks out of the range, enticing traders to engage in positions, enticing the average trader, enticing the impatient trader to engage at that level. With our style of trading, that does not interest us. What we are interested in is to see what price does around these liquidity points, what price does at the low of a range, or what price does at the high of a range. With the very next candlestick, this white one, we can see that price pulls back up. Price pulls back inside that range. Price pulls back above this particular level. So we've had price breaking beneath that level, and with the very next candlestick, we see price breaks back above that level. This is one variation of a liquidity grab. It is a candlestick closing. When we're talking about closing, we are talking about the actual body of the candlestick closing beneath that level. Remember, right in the beginning, we spoke about how these candlesticks form and that they have an open, a high, a low, and also a close. This blue candlestick had opened over there, pushed all the way down, and closed beneath that level, where the very next candlestick had opened over here, but closed back above that particular level. So that's one variation of a liquidity grab. The average trader, when price is approaching this level over here, they would be interested in engaging here. Some traders would be interested in buying as this blue candlestick still forming and pushes towards the low of the range. There are some traders that would be interested in buying here. There are other traders when price, like we said, breaks out beneath this low, breaks out of the range. Another type of trader would be interested in selling there. So we're not interested in engaging around these levels. We want to see what price does there. So this entices the average trader to engage, to put their account at risk, to expose their account to risk. We are not interested there. We are interested to see what price does around these levels before we engage. So that's one variation of a liquidity grab to the downside. This is your 2-hour time frame on your US 100 chart. And over here, this is the same portion of price, but simply on another time frame, on a 4-hour time frame. Same story over here. Price had been stuck in this little range, but it has thrown a massive wick beneath that low. So that's another variation of a liquidity grab. The first variation is this one, a candlestick closing beneath the low, followed by the very next candlestick closing back above that low. The second variation is price throwing a wick beneath that low. Those are your two variations of liquidity grabs. Now, in some cases, you will spot both on different time frames, but it's not necessary to spot both, okay? All you need to do is either spot this variation or this variation. That is a liquidity grab to the downside. That indicates to us that price could potentially reverse and continue to the upside. You won't execute any trades simply based on that liquidity grab pattern. What we'll do is we'll look for price to pull back, as you can see with the next candlestick, to pull back so that we can enter and then run to the upside, okay? Over here we see price had broken outside of the range, pulled back inside, grabbing liquidity beneath, and with that current candlestick pulling back, forming the lower wick, and then running to the upside, targeting the high of the range, and then also targeting those further liquidity points. The high of the range is also, as we explained previously, a region of liquidity because the average trader is interested in engaging there. So when you spot a liquidity grab to the downside, what do? That's one variation. That's another variation. If you spot either of those, what you are going to do is you'll be dropping down in your time frames to look for an entry point. So this is your 2-hour time frame. That's your 4-hour time frame. If you spot that, you drop down. Here we are on the 1-hour time frame of that same particular portion of price. Same story. We are simply looking for an entry point. If you don't find an entry point on your 1-hour time frame, you drop down another time frame. Here we drop down to the 30-minute time frame. We are looking for an entry point around the region that the liquidity was grabbed. So remember, we leave these markings on the chart because we want to identify, okay, price has grabbed liquidity around that region, the liquidity that rested around that low. So we want an entry point somewhere around that region. This is Just zooming in on that region, this region over here, we are zooming in on it to find an entry point. What we are looking for is we are looking for a gap over here in the region that the liquidity grab has taken place. Now, how do we identify this? In the same way that we identify imbalances. But over here, we're simply not using it for a target. Here we are using it for an entry point because there has been a liquidity grab that had taken place. So if prices grabbed liquidity to the downside, we are looking then to buy from that region. We look for a gap in price. Here's candlestick number 1, number 2, and number 3. Looking at the high of candlestick number 1 and the low of candlestick number 3, they do not meet up, leaving this gap in price. Now, this gap we refer to as a fair value gap. Fair value gaps and imbalances are the same thing. We simply just use the two different terms to differentiate between imbalances as targets and fair value gaps as entry points where there has been a liquidity grab. So essentially, we're looking for price to pull back, tap into the fair value gap to give us an opportunity to buy. Over here, we see price further forming, does not come down. It hasn't tapped our entry point as yet. You are simply waiting for price to come down, tap the entry point to give us an opportunity to buy and run price to the upside. In this particular shot over here, we see that price pushes to the downside, taps into the entry point. What we do is we buy as price kisses that fair value gap. And over here, we see price getting rejected from there. This screenshot over here, this is when the candlestick's still forming. It aggressively moves toward that fair value gap in order to give us a buy entry there to run price to the upside. Over here, we see price reaching the high of the range as a potential target. Okay, so your entry point is right over there. Let me just get my annotation pen out here. Your entry is over there, your buy entry. Okay, that's where you are looking to enter to run price to the upside. You can see there's really minimal drawdown on that trade. So just to reiterate, liquidity grabs to the downside can be spotted in two ways. A candlestick closing beneath a low, followed by the very next candlestick closing back above the low. Or by price throwing a wick beneath a previous low. When we spot a liquidity grab, we are dropping down in time frames to find a fair value gap in the region that grab has taken place. And we are looking to enter as price taps into that gap to run price to the upside. So a liquidity grab to the downside indicates the intention of price to move to the upside. We drop down to lower time frames to find a fair value gap to give us a reason to enter. Should you not find a fair value gap, then there's no reason to enter the trade. So your liquidity grab is essentially an indication to you of what price could do, and your fair value gap is your reason to enter the trade. These do not only occur at the low of a range, but also around previous prominent lows, even if price is trending. In this video, I'm going to show you guys how to catch a reversal if there has been a liquidity grab to the upside. And remember, as previously explained, that these liquidity grabs occur around liquidity points. They are identified as prominent highs or prominent lows in the market. And oftentimes at these levels, reversals can occur. Now over here in this particular portion of price, we're looking at the US 100 on the 1 hour time frame. And if we just look at this region of price over here, we can see that price has thrown a wick above this prominent high. How do we know that that's a wick being thrown above? We can obviously see the wick, but we see that the body of the candlestick closes back beneath that level. So that's one way that we'll spot a liquidity grab to the upside. This is your first variation. The second variation is a candlestick closing above that same high, followed by the very next candlestick closing back beneath that high. Now, this is the same portion of price, just on a 30-minute time frame. Those are your two variations of a liquidity grab to the upside, and this indicates to you the intention of price to move to the downside. Now, you do not have to spot both. You can spot one or the other, okay? You guys know that when we spot a liquidity grab, all we are looking for is an entry point. We drop down in time frames to spot an entry point on lower time frames. We do this by looking for a fair value gap. Should there not be a fair value gap on lower time frames in the region that the grab has taken place, then there is no reason for us to pull the trigger. This is your 30-minute time frame, so what you'll do is you'll drop down to a time frame lower, which is the 15-minute. If you do not spot a fair value gap, then you drop down to the 10-minute. You do not spot one there, drop to the 5, to the 3, etc. Over here, we dropped all the way down to the 1-minute time frame. And on this time frame, if we just zoom in on this region of price over here, we find that we have a fair value gap over here. We spot this by 3 consecutive candlesticks, this blue one, and this white one. There are 3 consecutive candlesticks. If we look at the low of candlestick number 1 and we look at the high of candlestick number 3, they do not meet up, leaving a fair value gap in price. All we are then looking for is for a candlestick to pull back, tap into that region to validate a sell entry. Over there, we see price pulling in. Over here, just zoomed in, you can see that by the wick of this particular candlestick. You execute your sell as price taps the fair value gap. And here we see price running to the downside. So a liquidity grab to the upside indicates the intention of price to move to the downside. You drop down to lower time frames to spot a fair value gap. If there is not a fair value gap, there is no reason for you to enter the trade. Also, if there has been a fair value gap, but price has already tapped into it, we will not execute any trades because this fair value gap is no longer fresh. If there is a fair value gap that is fresh, like the one we had over here, as soon as price kisses it, that's where we are looking to sell. Just to reiterate, liquidity grabs to the upside is either a candlestick throwing a wick above a previous high and then closing back beneath, or a candlestick closing above a previous high, followed by the very next candlestick closing back beneath that high. We then drop down in time frames to find a fair value gap to validate an entry. And as soon as price taps that fair value gap, we engage with sell positions. In this section of the course, we'll be going over some entries. So essentially what I'm going to be doing is showing you trades that we had taken with the analysis leading up to those trades based on everything that I've taught thus far. So we're going to be starting with a trade that is based on a supply zone. This over here is a gold trade, and this is your 1 hour time frame on gold. Over here, we can see that we've had momentum to the downside. That is our first indication of what we can potentially be expecting. Now, if we've had momentum, we need to identify whether that momentum has broken structure. Remember our 3 steps. Number 1, identify momentum. Number 2, ask yourself whether that momentum has broken structure. Remember, if it hasn't broken structure, the momentum has no context for us. Over here, it actually has broken structure to the downside, and then we can move on to step number 3, which is to identify the indecisive candlestick prior to that momentum, which has led to a break of structure. So over here, we know that from the supply zone, we are looking to sell when once price returns there. A break of structure to the downside with momentum indicates to us that sellers are in control. You'll see over here that I removed the break of structure line. I always remove that. I put it on as a matter of habit to ensure that it is a valid zone that I am identifying, but I remove it so that my chart remains nice and clean and only leaving my supply zone. So always make sure you put your break of structure marking on your chart, but you can remove it afterwards so that your chart remains nice and clean. Now, over here, we see price doing a correction, and it is pulling back towards our supply zone from which we are interested in selling. Over here, we have prominent highs, because over here, prominent lows, because over here, the manner in which price has returned to our supply zone has now created these lows in the market. Here's a low that's been created there, and then when price does a bit of a pullback here and moves back up again, it creates another low. So these would be liquidity points that we can use as potential targets. And sometimes, just like this example over here, we might have more than one target for our trades. So you're welcome to use either the first target for your trade, or you can potentially look for price to push through that one to the next one as well as your second target for the trade. Over here with this candlestick, you'll see that price literally pushes up, taps into our supply zone to give a sell entry, and from there proceeds to the downside. So it's literally probably like really minimal drawdown on that trade. It's literally entering and price moving in your direction. And over here with these following candlesticks, we see that price reaches your first target as well as your second target. Okay, so those are both targets hit on that trade. That is a trade taken from a supply zone using liquidity points as targets for the trades. Over here, we see that that's the screenshot of the trade, entry in over there, and here's price running to the downside. In this video, we'll talk about a trade taken from a demand zone using imbalance as a target. Now over here, this is the German 40 on the 1 hour time frame. And over here, we can see that we've had momentum to the upside. And if we zoom in on that region over there, we'll just focus on this bit of momentum over here. Remember, the first thing you want to spot is momentum. Here's your entire impulse over here. But here you can see price gets a bit indecisive based on these candlesticks. So we want to focus over here. We want to ask ourselves, has this momentum broken structure? We can see that there has been a high over here, that this momentum has in fact broken. We can then look for the indecisive candlestick prior to the momentum, which led to the break of structure. We can see that the structure is broken because this candlestick over here has closed above that high. This is the indecisive candlestick, the little white one over there, the indecisive candlestick prior to the momentum which led to the break of that structure. Over here, we've just once again removed the BOS marking so that our chart remains nice and clear, and we have extended the demand zone to the right-hand side. We're looking for price to push down into this demand zone to give us a buy entry. Over here, we see price pushing down with that candlestick, tapping into the demand zone in order to give us a buy entry. Now, on the way down to the demand zone and reacting from the demand zone, looking at the 30-minute time frame again, we can see that price has left behind a bit of imbalance, identified by 3 candlesticks, 1, 2, 3. We look at the low of candlestick number 1 here and the high of candlestick number 3 over here. They do not meet up, leaving this region of imbalance. So buying from this demand zone, we would use this imbalance as a target for the trade. Over here, we see price running up, filling that imbalance completely, and then pulling back from there. That's the trade over there. Entry in over here at the bottom, running up, filling the imbalance, and that's the trade complete. The screenshot is obviously taken on a 15-minute time frame, but the imbalance was identified on the 30-minute time frame. These additional entries over here, those were scale-ins, and we'll talk about that a little bit later in the course. In this video, we'll be focusing on a liquidity grab to the upside using a liquidity point as a target. Now over here we have the NAS 100 on the 8-hour time frame. Over here we can see that we've had a high over here that the price has created, and over here we've got price pushing up and then closing back beneath that particular high. So price has thrown a wick above that high, which is an indication to us of a liquidity grab, and for us to look for a potential opportunity to sell. We have got the same screenshot, just zoomed in a little bit more for you guys to see it a little bit clearer. Actually, liquidity grab to the upside. You know, when we have a liquidity grab to the upside, we're simply dropping down in time frames to find an entry point on a lower time frame. Over here, we've dropped down all the way to the 5-minute time frame. For example, this liquidity grab was spotted on the 8-hour time frame, so we'll drop down to the 4-hour time frame, simply to look for a fair value gap. If there is none, we'll drop down to the 2-hour time frame to look for a fair value gap, and so on until we find one. If we do not find a fair value gap, there's no reason for us to pull the trigger. Over here, we went all the way down to the 5-minute time frame, and in this region over here, we found a fair value gap. A fair value gap that was completely fresh, meaning that price had not returned to it yet. You always want fresh fair value gaps. You do not want ones that price has already tapped into. Now over here, we've got our entry point. And over here, we've got a prominent low, which is also a liquidity point. So if price would push up, tap into this region to give us a sell opportunity, we would look to sell price down, targeting this particular level over here. Over here, we see price pushing up, tapping into our fair value gap to give us an entry point to sell from in order to run price down to this liquidity point at the bottom as our target. And that's the trade over there in line with that analysis. In this particular video, we will be focusing on a liquidity grab to the downside using a liquidity point as a target. Now, what's interesting about this particular example as well is that I want to show you what to do if price has grabbed liquidity on both ends. Because over here we can see we've got this previous low that price has grabbed liquidity beneath. But we've also got this high over here, or these relatively equal highs that price has grabbed liquidity above. Now this was a trade taken on a news release. This was the NFP news release. And also I just want to show you that even when there are news releases, these same principles apply. Obviously, the risk in relation to this, because it is high impact news release, is a little bit higher. So you want to be cautious, but not scared. Okay, so how do we identify that we've had a liquidity grab to the downside? We identify that by this blue candlestick closing beneath that low, followed by the very next white candlestick closing back above that low. How do we identify the liquidity grab to the upside? We've had a candle, the white one, closing above these highs, followed by the very next one closing back beneath. Now, this can be a little bit confusing because prices now grabbed liquidity on both ends, and it might be, challenging to identify where do we engage from. Is it going to sell or is it going to buy? What we do then is we drop to lower time frames. This is your 15-minute time frame on your NAS 100 chart. But if we drop down to the 10-minute time frame, we can see that we've had a fair value gap on the downside over here that price could potentially pull to in order to rocket to the upside. But we want to make sure that we do not get caught in a situation where price, in fact, sells off from this region because we know there's a liquidity grab that has occurred to the upside. If we drop down further, this is your 3-minute time frame, we can see that there is a fair value gap in this region over here. That's your fair value gap over there, but we can see prices already tapped into it. So this over here is not a fresh zone. However, this zone over here, it remains fresh. Obviously, we cannot see the fair value gap on this time frame because this is the 3-minute, but remember we had identified it on the 10-minute time frame. So this one remains fresh. So this means that price can then potentially from here push down to that region in order to push price to the upside. So always pay attention to that. You always want to be executing from fresh zones. Over here, we see that from that zone, price pushes to the downside just prior to the news, and it taps into this fair value gap that was identified on the 10-minute time frame. So remember, we had a liquidity grab to the downside. We identified a fair value gap in the region of that grab. Here we see price had reacted. So your entry is already in over there just prior to the news, okay? You would have bought on the tap of this fair value gap, already pulling you into profits over there. Okay, if you want to look at it on the 10-minute time frame, it's just, this was just showing you, how price had reacted from this one, pushing it down to that particular fair value gap. Okay, I'm going to be focusing on the buy now. I'm back on the 10-minute time frame just to show you guys. I just wanted to give you context in the previous screenshot. So if we're buying from this 10-minute fair value gap beneath, we would then need a target for our trade. Over here, we have a prominent high. Should price push down to this region, that would be our first target as a liquidity point. But we know this is a news release, so price can potentially even push right through that and go to our next target, which is this liquidity point over here, that prominent high. So that's price pushing down, tapping into the fair value gap in the region of the grab, reacting from it, and then as the news is released, it continues to the upside. So we've had a fair value gap in the region of the grab to the downside. Remember, your liquidity grab to the downside was spotted on the 15-minute time frame. You're welcome to rewind if you need to. We drop down to the 10-minute, and that is where we found a fresh fair value gap in the region of the grab. Price pushed down to that to give you an opportunity to enter a buy position, and with the news, price continued to the upside, targeting that liquidity point as your first target and that liquidity point as your second target. This was an NFP news release, and that is the trade over there. This news was released at 2:30. You can see that by 33 minutes past 2, that's the time that the screenshot was taken. Entry in right over there. That's about 100 points within about 3 minutes. In this particular video, we will be focusing on our conservative entry method, which is also a method that can be used to scale in to positions that you're already running in profit. Now, over here, we can see same story. We've got momentum to the upside. This is on your 4-hour time frame on your NAS 100 chart. This momentum has broken structure. And this is the indecisive candlestick prior to the momentum that has led to the break of structure. It is the little indecisive blue candlestick over here that forms our demand zone. Now, if we zoom out a little bit, we can see that this zone, if we stretch it all the way out, we can see that it has been created on the 19th of July. We've got August over here, so that's the 18th of July. This over here is the 19th of July on which that zone was created, with a momentum to the upside that has broken that high. So this portion of price over here is this over here. You can see that these zones remain valid. until price returns there. Even though it was created on the 19th of July, and the remainder of the month of July, price never returned there. The entire month of August, price has not returned there. And here we are in the month of September, it still remains valid until price returns there. Okay. What we do and why we use the conservative entry method is when the risk on any particular zone is too large and we want to minimize that risk, we use our conservative entry method. Over here, I'm measuring the range of that zone. Basically, we measure it from the high of the demand zone to the low to identify what the potential risk is on that trade. Over here, we can see that the risk is 50 points. Now, what we do is we measure the zone and we add about 3 to 5 points on just to accommodate for spread, etc. So the actual range of the zone is 45 points, but we are adding an additional 5 points on just to accommodate for that spread. And therefore the risk over here would be 50 points, which is way too large. Ideally, you don't really want to be engaging with trades with an aggressive entry with a risk greater than like 30 points or so. That's my personal preference. You might differ. You might have a greater risk appetite. But me personally, if a range of a zone is greater than 30 points or greater, I'm going to be looking for a potential conservative entry. So over here, we see price pushing down, tapping into the demand zone. Your aggressive entry, as we've taught all along now, is as price taps the zone you're looking to enter. But because of the risk on the zone, because it's large, we want to look for further confirmation. And that is where our conservative entry comes into play. Over here, we can see that price has rejected from that particular zone. But what we do is we drop to lower time frames to identify a potential conservative entry. So we look for price then to push into the zone and react from it. This is the same for our demand zone, but over here we are looking at it on a 3-minute time frame. When looking for conservative entries, we use the 1-minute time frame, 2-minute, 3-minute, and sometimes even the 5-minute time frame. Now, we're looking for price to tap into the zone and react from it, leaving us with a fair value gap. Okay, we can identify that by 1, 2, 3 consecutive candlesticks. If you look at the high of the little blue candlestick over here and the low of this blue candlestick, we can see that price has left a fair value gap over there. What we are going to look for is for price to tap into that fair value gap to give us an entry. And that is our conservative entry method. Okay. It basically just gives us further confirmation that price is going to react from that zone, and we'll then use it as an entry method. You can also use this method to, as a scale-in method. If you had taken aggressive entries on the tap of your demand zone and you drop to lower time frames and you see price doing this on your lower time frames, you can use this as a region to enter an additional position from. Now, also, as you know, we always need targets for our trades. On this particular one, I identified that as price came down, this is your 15-minute time frame, as price came down toward that 4-hour demand zone, it had broken this low over here, leaving imbalance over there. So with this particular opportunity, I am looking for price now to tap into this fair value gap, the 3-minute one, to run up and fill the 15-minute imbalance. Over here, we see price pulling in to give us the conservative entry. We buy on the tap of that fair value gap, and then we see price running up to fill that imbalance above. And that is the trade over there. Entries in right over there. In this video, I'll be showing you how we trade based on news releases and also how to manage your trades while in a live market. Now, this particular trade is a trade taken on the Euro USD, which is the currency, the Euro against the US dollar. With this little block over here, you can see that this is a screenshot taken from our investing.com app. And it is a 3-bull news release. It is a US news release. And the release that it is core durable goods orders. Now, with news releases, as I stated previously, we use the exact same principles. If there is no setup, there is no need to take any trade. Okay? Do not ever trade news releases based on hype or based on FOMO, which is fear of missing out. Only trade if there is a valid entry offered to you based on our style of trading. Now, we're focusing on the Euro USD because it's US-based news release. It's a US-based news release, and the US dollar is obviously in this pair. It is paired with the Euro over here. On the 15-minute time frame over here, we can see that we've got bullish structure. We can see that price is in an uptrend. Over here, we can see we've had momentum to the upside prior to the news release, and that momentum has broken structure to the upside. We can then look for the indecisive candlestick, the little white one over here. That's your indecisive candlestick prior to the momentum that has broken the structure. As you guys know, we always remove the BOS marking on the chart so that our charts remain nice and clean. With any trade, we always want an entry point, but we also want a valid target for the trade. Over here, I went up to the 2-hour time frame to identify an imbalance that can be used as a target for this trade. That was the only time frame that I could find a valid target on for this particular trade. So going back to the 15-minute time frame, we've got our demand zone, which is our entry point, and we've got our imbalance above, which is the potential target for this trade. So we're looking for price to pull back, tap into the demand zone to give us a buy entry in order to run it up to fill the imbalance above. At the time that the news was released, you can see that price pushes down, taps into the demand zone to give us a buy entry, and pretty much immediately runs up from there. Now, if we go down to the 1-minute time frame, here we can see price had tapped into that demand zone. That is the 15-minute demand zone. We are just looking at price on the 1-minute time frame over here because this is a news release and we are wanting to manage our trades effectively. Entry in over here, but you can see that what price does is it actually creates bullish structure on this 1-minute time frame. What we do then is, if price breaks highs on these lower time frames, you want to take your stop loss and trail it. Now, your stop loss is not only a means to stop you from losing any further, but it can also be used as a means to protect your profits in a running trade. So over here, when once price with this momentum has broken above this particular high, we take our stop loss and we trail it over here. We can put your stop loss there so that should price pull back, at least it will knock you out over there and you'll walk away with all this profit being banked into your trading account. Price is obviously pulling into our imbalance and we are anticipating price filling that, but we want to protect the trade because we are running in beautiful profits over here. Over there, we see what price had done from that region after we had trailed the stop loss. We see price had pulled back, knocked us out in profit, and then after that, price pretty much became a bit lethargic and eventually ends right back at where our entry point would have was on this trade. You do not want to end up in that position, and so therefore, it is important that you manage trades wisely by trailing your stop loss. That's the screenshot of the trade, the entry in over here, okay? And over there, the stop loss, you can see it's trailed into profit. So should price reverse over there, it will knock you out over there, but at least all of this profit here will be banked into your trading account. Now, this is 15 minutes after the news release. So it had taken about 15 minutes for price to sort of get up to this region. And over here, we see price reversing. And this is a screenshot taken just prior to it knocking us out in profit over there. In this video, we will be covering something very, very important, and this is where to place your stop losses. So for sell positions, when you're selling from a supply zone, you want to place your stop loss above your supply zone, about 3 to 5 points above the supply zone to accommodate for spread, etc. If you are selling from a fair value gap, whether that is a fair value gap based on a liquidity grab, or whether it is a fair value gap based on a conservative entry, you want to place your stop loss above candlestick number 1 in the series of the 3 candlesticks that form the FVG. Remember, it takes 3 consecutive candlesticks to form a FVG, so you do not want to place your stop loss simply above the gap, but above candlestick number 1 that had formed that gap. If you are taking any buy positions, you want to place your stop loss beneath your demand zone if you are buying from a demand zone. Also, once again, 3 to 5 points beneath your demand zone, just to give price room to breathe and to accommodate for spread. If you are buying off a fair value gap, whether that is a fair value gap in the region of a liquidity grab to the downside, or whether that is a fair value gap based on your conservative entry, you want to place your stop loss beneath candlestick number 1 in the series of 3 candlesticks that had formed that fair value gap. You do not want to place it simply beneath the gap, but you want to bear in mind that it has taken 3 consecutive candlesticks to form that fair value gap. And so therefore you place your stop loss beneath the candlestick number 1 in the series of those 3 candles that had formed the fair value gap to accommodate for spread and to give price some room to breathe. In these videos, we'll be focusing on rules and risk management. Now, you want to think of this in terms of sport. You could be the most amazing player on the field, but if you are not playing by a set of rules, you'll get sent to the bench every single time. So you could be the most amazing trader, but you need to be playing by a set of rules. Just like every sport has a set of rules, and those rules need to be adhered to, the same is true in trading. Risk management is super important as well, as this is what will keep you in the game. Now, time is a very important factor in our trading style. You want to be choosing an instrument and then pairing that instrument with a time or a trading session relative to that instrument. You want to think of this as, let's say, for example, we opened a restaurant. If the restaurant we opened was to sell breakfast, then the most highly probable time that we can anticipate an influx of business is in the morning, because we are selling eggs, we are selling croissants, we are selling muffins, we are selling cereal, etc. And so it is not impossible for us to anticipate getting clients or customers in the evening, but it is more highly probable for us to get an influx of business in the morning. So it's always important to pay attention to which instrument it is that you are trading, and then trading it at a time that is relevant to that particular instrument. Now, the Forex market is open 24 hours a day, 5 days a week, and it is divided into different trading sessions based on the major financial centers around the world. There is the Sydney session, the Tokyo session, or combined that may be referred to as the Asian session. We get the London session as well as the New York session. And then when trading indices, these indices are you want to trade them at times that the relevant stock exchanges in relation to those indices are open. You also want to bear in mind that daylight savings time might affect your trading time. So you want to have a look at what zone you are in, which region you are in, and pay attention to when daylight savings time affects the regions in relation to the instruments that you are trading. So, for example, if you are looking to trade during the Asian session, you want to then be trading instruments that are relevant in that particular session. If you are trading the London session, you want to be trading instruments that are relevant to that session. If you are trading the New York session, you want to be trading instruments, once again, that are relevant to that session. And then when trading indices, like I said, you want to trade these during the times that their respective stock exchanges are open. For example, when trading NAS 100, we want to trade it around the time that the New York Stock Exchange is open. Now, the New York Stock Exchange is open from Monday to Friday from 9:30 a.m. This is Eastern Daylight Time, and it is open up until 4 p.m. We want to trade this instrument during that window. So it is not unlikely for us to find opportunities outside of that window. However, our most highly probable opportunities will occur during that window. Just think of the restaurant example. If we opened a restaurant and we were selling breakfast, our most highly probable time to have an influx of business would be in the morning. It is not unlikely for us to have business, get an influx of customers in the evening, but it is more highly probable in the morning based on the type of meal we're serving. And you want to apply that same logic to your trading. When we're trading the German 40, for example, you want to trade this around the time that the Frankfurt Stock Exchange is open. And the Frankfurt Stock Exchange is open once again from Monday to Friday from 9 a.m. German time. And this obviously you want to pay attention to how that relates to the time zone that you find yourself in. Now, a very important rule that we apply to our trading is to not look at price, to not open a chart irrelevant to the time that you are looking to analyze. So, for example, if you are looking to trade the NAS 100, you do not want to be analyzing that chart during the London session because it's still got a couple of hours for price to form before we enter the session in which the New York Stock Exchange is open. So you want to allow price to play out and then show up about 30 minutes before the session that you intend to trade and then start doing your analysis, because by then you would have enough data to work with. Also, we encourage our traders to set alarms so that you never miss the open of the session that you are interested in trading in. So, for example, these are alarms that I have set on my phone. I obviously change them when it, in relation to daylight savings, but I set it about 45 minutes before the session that I anticipate trading. And this is so that my alarm can notify me, hey, listen, it's time to start getting ready. And if I'm still busy with something, I can just snooze, snooze, snooze until I am sitting in front of my PC. Remember that we trade because we want freedom. And so it is counterproductive then to become a slave to the chart. Don't find yourself slaving away in front of these charts, sitting in front of these charts, watching these candlesticks form all day. Our style of trading is geared towards freedom, and so therefore you want to engage with these charts at relevant times, and you also want to allow price to play out and not watch it play out. Allow it to play out, and then prior to the session you are interested in trading, do your analysis with all the information that price has already provided. These are our 4 gets: get on, get in, get out, get along. Get on your chart when your alarm goes off in order to analyze. Get in your trade when price gets to your entry point. Get out of your trade when price gets to your target, and get along with your day. Lastly, remember that this is a one-player game. So many people get caught up in the situation where they are in joining various free trading groups, this free signals group and that free analysis group and that chat group. All this is going to do is it's going to cloud your mind. This is a one-player game, and so you want to focus on you and you want to focus on your journey. If you intend to be an independent trader, it is best to learn one style of trading and focus on that style of trading instead of hopping all over the show. Always remember that this is a one-player game, and so, don't get caught up in that particular trap. Now, in terms of risk management, this is a very, very important part of our trading, okay? Risk management is what will keep you in the game if you follow it effectively. Now, in terms of your risk to reward ratios, what you want to do is do not engage in trades that have a risk to reward ratio of less than 1 to 2. This means that if you are risking $1 per trade, then you want to ensure that you are able to at least make $2 on that particular trade. So this, by choosing to engage in quality trades like these, it will keep you in the game. An example of that is, let's say you are buying from a demand zone, and the risk on that demand zone is 20 points. You want to ensure that you have a target that is at least 40 points away from the price you are looking to enter at. So if you lose that trade, you would lose 20 points. But should you win that trade, you would win 40 points. Let's say you won that trade, winning 40 points. You would have gained 40 points on that particular trade. And let's say you took the exact same setup thereafter, maybe the following day, and you lost that trade. You would have lost 20 points. My apologies. Now, you would still be up in profit because by winning 40 points the previous day and losing 20 points on that particular day, you'd still be up 20 points in profit. And so therefore, it is very important to engage in quality setups. There are instances where you might get a 1 to 3, 1 to 4, 1 to 5, even a 1 to 10 risk to reward ratio. But you do not want to engage in trades that have a risk to reward ratio lower than 1 to 2. Your stop loss, don't move your stop loss or remove it when you are in the red. Your stop loss is there to stop you from losing any further. And so when you identify a trade, identify the risk on the trade. If you are happy with that risk on the trade, place your stop loss in place. Once again, let's say we use the demand zone example. You buy on the tap of the demand zone. You place your stop loss beneath the demand zone. If price approaches your stop loss, do not remove that stop loss. Do not take that stop loss and move it further away. Because what you are doing is you are simply exposing your account to further risk. Identify where your stop loss needs to be, leave it there, and if price approaches it, allow it to hit. This is there to stop you from losing any further. It is a means of managing your risk effectively. Now, don't remove it as well. If you remove it, you are exposing your account to further risk. Okay, remember that we are not going to win every trade. We have a set of rules. We approach price with a rule-based style of trading, and these rules are put in place to minimize potential losses and to strengthen the potential of price going in our favor. But we are not going to win every single trade. So therefore, it's important to assess the risk on a trade, identify whether you are happy with that risk, and then execute the trade, place your stop loss in place, and do not move it. The only time you want to be moving your stop loss is when you are trailing it into profit at valid regions, just like we explained in one of our trades in the entries chapter. Your lot size is pertaining to the amount of your actual equity that you are assigning to a particular trading opportunity. Okay, so you do not want to over risk. use lot sizes in relation to your account size. For example, when you go to the shop to buy anything, you do not buy something that you know you cannot afford. You do not buy something if you know, hey, listen, this costs more than I actually have in my bank account. Or if I buy this, I'm going to be sort of using my last money. You want to approach price or trading with the same mindset. Risk effectively, risk in accordance with your account balance. Do not over risk, because that's going to cause you to be put out of the game prematurely. Okay, so use lot sizes in relation to your account balance. Also, bear in mind that various instruments, you are going to be using different lot sizes. For gold, your lot size will be different as opposed to indices, etc. For currencies, it will be different as well. Always ensure that you are using a lot size that is relevant, a lot size that is relative to your account balance. In this particular video, we'll be talking about our trading plan. Now, if you go to the ITSA library on Telegram, you will find that there is a document named Trading Plan. This is essentially a plan to keep you within safe parameters. So we encourage you to go and find that document in the library, download it, complete it, stick it up next to your trading station, screenshot it, put it on your phone, etc. It is very important to trade using a trading plan in order to keep you within safe parameters. In this video, we'll simply summarize everything that we have taught throughout this course. Now, remember, our trading style is of a day trading nature, meaning that we enter and exit our positions on the same day. However, should you wish to swing trade, meaning holding trades for a couple of days or a couple of weeks on end, the same principles can be used on the higher time frames only. Should you wish to scalp, meaning entering and exiting trades in a couple of minutes, just taking like small trades, small chunks out of the market here and there, the same principles can be used on the lower time frames only. However, we predominantly focus on day trading. Now, the trading apps that we use TradingView for analysis, and we only use charts provided by Awanda. We use MetaTrader 5 for execution of our trades. We are logged into our trading account via MetaTrader 5, and that is the platform that we use in order to execute our trades. We use investing.com to identify our news releases that are occurring for the day or the week. We only look at the high impact news releases, which are identified by looking for the 3 bull news releases. We have tutorials for all of these in the library on Telegram. Our market structure is used to identify in which direction price is trending, and it is characterized by prominent highs and prominent lows that price creates as it flows. In any market, we'll have the following trends. We'll have a downtrend, which is referred to as a bearish trend. We'll have an uptrend, which is referred to as a bullish trend, or price might simply be stuck between a floor and a ceiling, which we refer to as a range. Now, when price is trending, it'll move in 2 phases, an impulse phase and a correction phase. Your impulse is your aggressive moves with momentum, which lead to breaks of structure. Your correction is essentially your pullback. Now, in terms of imbalance and liquidity, this is what we use in order to identify targets for our trades. It is important to always remember that price moves for 2 reasons and 2 reasons only. And if we understand why price moves, we can understand where price could potentially move to. The price will either fill imbalance or hunt liquidity. And so therefore, when looking for targets for any trades, we'll either look for imbalance or liquidity points as targets. Sometimes you might have imbalance as well as a liquidity point that can be used as a target. And sometimes you'll simply only have imbalance, or you'll simply only have liquidity points. So if you are buying, you'll be looking for either imbalance or liquidity points above price. If you are selling, you'll look for either imbalance or liquidity points beneath current price. Imbalances are created by a series of no less than 3 consecutive candlesticks. It is measured from the high of candlestick number 1 to the low of candlestick number 3 in this example, because this is buy side imbalance. This imbalance has been created because there's been a surplus of buy orders in the market as opposed to sell orders. It creates this imbalance in price because of the imbalance of buyers in relation to sellers in the market over here. Okay, we obviously go into more depth on this in the course, and it is important that you complete the course before watching this. That's your imbalance created to the upside, and this is imbalance created to the downside, right? This imbalance over here, once again, 1, 2, 3 consecutive candlesticks, and it is characterized or identified by the low of candlestick number 1 to the low of candlestick number 2. And notice that it says buy side imbalance here. It is in fact sell side imbalance, because here has been a surplus of sell orders injected into the market. Now, these imbalances can never be created by you and I. These imbalances are created because of institutions, big banks, hedge funds, financial institutions, okay? Because of the amount of orders that are being pumped into the market, price moves aggressively, causing these imbalances. Now, it's important to take note of these imbalances because price will be drawn to these regions, balance price by filling these imbalances. Now, over here, we can notice an example. Prices return to a demand zone. This demand zone is characterized by that momentum which has led to this break of structure. Upon price returning to this demand zone, it has now created imbalance above. So should we buy from this demand zone, we need to pay attention to the imbalance above. And when once price fills that imbalance, you want to get out of the trade. That is your target for this particular trade. And we see that from there, price actually reverses. Now, it's possible that price could continue after filling imbalances, but sort of once it fills that imbalance, it becomes a bit of a 50-50, right? So we want to use that as a valid target for our trade. Liquidity point, these are our fixed price levels on the chart, and price can oftentimes be drawn to these regions, but it can also reverse from these levels, okay? Over here, we've got another example. We had momentum to the downside that has caused price to break this particular low. The white little indecisive candlestick, that forms your supply zone. On the way up to the supply zone, price has now created a liquidity point to the downside, characterized by this prominent low. Over here, we see price tapping into the supply zone, give us an opportunity to sell. And over here, we see price selling off toward the liquidity point. And from there, it reverses pretty much. Now, remember, like we said, price can reverse from these levels. The manner in which we can engage from these levels will be discussed in these next couple of videos. Now, when price reverses from these levels, we refer to them as liquidity grabs. Now, liquidity grabs will occur at liquidity points. These can be the low or high of a range. It can be around a prominent low or around a prominent high. These will occur around liquidity points. Now, this is one variation of a liquidity grab to the downside, a candlestick closing beneath a low, followed by the very next candlestick closing back above that same low. This is the second variation of a liquidity grab to the downside, price throwing a wick beneath the low. So you'll either spot one or the other. Sometimes you might spot both on various time frames, but you only need to spot one or the other. When you spot a liquidity grab to the downside, you are simply dropping down in time frames to find a fair value gap in the region that that grab has occurred. You'll look for price to pull back to that gap, and that is where you will buy. If price has grabbed liquidity to the downside, we are looking to buy. A liquidity grab to the downside indicates to us the intention of price to move to the upside. Your fair value gap in the region of the grab gives you a reason to pull the trigger. Now, liquidity grabs to the upside. Once again, same story, just in reverse. It can either be characterized by a wick thrown above a prominent high or by a candlestick closing above a prominent high, followed by the very next candlestick closing back beneath. You only need to spot one of these two variations. Sometimes you will spot both on various time frames, but it is only necessary to spot it in one of these two variations. Now, in terms of this, when looking for an entry, you're going to be dropping down. A liquidity grab to the upside indicates to you the intention of price to run to the downside. But a fair value gap, a lower time frame fair value gap in the region of that grab gives you a reason to engage. Over here, we've got that fair value gap. We identify fair value gaps in the same way we identify imbalances. We obviously just use the two different terms to differentiate between imbalances for targets and fair value gaps for entry points. Over here, you see price pulling in to that fair value gap, tapping in to give you a sell opportunity to run price to the downside. Also, guys, we have an active mentorship program. Now, I know some traders are already skilled traders, just doing another course just to upskill themselves or just to view the market from a different angle. And so a skilled trader might not need access to a mentorship program. However, it is a pivotal part of any new trader's trading journey. So we encourage you to reach out so you can get access to our mentorship program. Even if you aren't a skilled trader and you just want to see how we do things, how we implement these principles in a live market, by all means, reach out. It is absolutely free. It is run in partnership with our broker. And so all you need to do is request the link to open up your trading account, simply fund your trading account, and you'll automatically get free access to the course. There are details in this channel. In order to get access to it, please follow that and we'll gladly get you plugged. Okay. In the mentorship program, we give you daily updates, helping you identify what news releases will be moving the market for that particular day. We give you pre-market chart analysis, reiterating the principles that were taught in this course, but in a live market. We give you live market updates, teaching you how to think in a live market and how to implement what we have taught in live markets. You also get access to our weekly mentorship calls where we use current chart data to reiterate these principles once again. We answer any relevant questions or common questions we've got in the week leading up to that mentorship call in that call. You'll also get access to our handbook, which is basically a reference guide for our traders based on our style of trading. See you on the inside.